Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, financial markets continue to have a tough year.
Yes, they do.
Temporary market drawdowns feel much worse than long-term market gains feel good to people. So to compound the problem, the more you look at your accounts when the markets are falling, the worse you're going to feel. So let's talk about some of the ways you can weather a tough investing environment like we are seeing right now.
Well, Steve, the longer you can stretch out your time horizon, the larger advantage you have when investing. And we all know this, but often we have to remind ourselves, and we can do that with some data. So if you take a look at the chart on your screen right now, going back to 1927, if you would have checked the market daily since 1927 to now, 52% of the time, you would have seen a positive return. Better than half, not great. Now let's say you only looked at the markets weekly over that same time frame. You'll notice that 56% of the time, markets are positive over that time frame. Now let's say you zoom out and you only look at the stock market once per year, going back to 1927. 75% of the time, you're going to see a positive return.
That's great.
And those numbers only get better the larger or the longer you stretch out, the time frame. So stretching your time frame also applies to how often you check your investments to maintain your sanity and prevent you from making emotional decisions. The less you look at your investments, particularly during volatile times, on balance, the better off you're going to be.
So Travis, speaking of emotional decisions, the media will always come up with reasons for you not to invest. Going back to 1927 again, like you did, the list on your screen gives you 95 reasons over 95 years not to invest in the markets. But over the long term, had you stood on the sidelines and paid attention to all the reasons not to invest, you really would have missed out on some great returns over those years.
You certainly would have. And Steve, people will also use those same 95 reasons to sell out of investments during volatile, market times. And that compounds the problem, because when you sell out, you've now become a market timer and you're no longer an investor. Because now you have to decide when to reinvest, which doesn't work out well most of the time. If we go back to 2001, and let's just say you invested in the MSCI All Country World Index and stayed invested that entire time, your average annual return would have been around 7%. So over those 21 years, let's just say you missed the 5 best days. Over 21 years, the 5 best days. Your average annual return over that same time frame falls to 5%.
Wow.
Now, let's just say you missed the 15 best days over that 21-year time span. If you just missed the 15 best days, your average annual return falls to 2% per year, barely keeping up with inflation over that time frame. Not now, but over that time frame. So market timing generally causes more harm than good. And you may get it right once, but getting it right consistently over a long time frame is going to be much tougher.
So Travis, to summarize, short-term market volatility hurts. It's normal to feel uncomfortable when this happens. We all do. But when you feel this way, it is important to take a step back or zoom out, like you said. Look at your financial plan that you've created with your financial advisor and determine how did those short-term setbacks affect your financial future. If you do view it through that lens, these drawdowns that we're experiencing right now will not be as painful.
Yeah, they'll be much less significant, Steve. And our advice to people is generally, empower yourself in these situations.
Absolutely.
Focus on what you can control, which is your savings, your spending, your asset allocation. And on top of that, work disruption into your plans. If we all know the world is going to be disrupted from time to time. It happens. We've all lived long enough and seen it. And if you're allocated right and you plan for disruption, the short-term drawdowns or the short-term market volatility, we can take advantage of those. And if we do that, that generally turns into beneficial long-term gains.
That's absolutely right, Travis. I couldn't agree more. I look forward to it next week.
Look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.